So let's move on to Brennan, where a segment where Brennan's going to prove he can read, which is impressive.
Yes.
So he's going to talk about, in our Legendary Investor series, Peter Lynch. Take it away, Mr. Reader.
Okay. So, yes, I can read. Not very well, but I can read. Okay. So, I thought that I would do an investor spotlight on Peter Lynch because, yes, I can read. I'm reading his book right now. I'm only through the introduction, which he wrote in
2
2000.
pages.
So this was kind of like right before we saw the fall off of the tech bubble in 2000. So it is interesting, and I thought I could kind of relate to where we're seeing valuations now, or where we were seeing valuations and whatnot. And then I'll kind of share some quotes at the end. So Peter Lynch, who is he? Here we go. He is a proponent of value investing and helped popularize the growth at a reasonable price, or GARP, stock investment strategy, which is what we follow at Keystone. And essentially, he came to prominence because he managed the Magellan, I believe I'm saying that right, Magellan Fund at Fidelity Investments. Magellan? Thanks, Ryan. Magellan Fund at Fidelity Investments between 1977 and 1990. And he produced an average annual return of 29.2% over that period, which is pretty impressive. And then as well, he is the author of a few books, including One Up on Wall Street, which he published in 1989. And this is the one that I'm reading. And this book is kind of more about his theory in value investing. He also published Beating the Street in 1994, which is kind of application of the strategy itself. And then also Learn to Earn in 1995, which is more for teenagers and getting them interested in investing. So here's a chart just showing the growth of $1 over the time that he was at Magellan. So that $1 if it was invested in Magellan, would have turned to $28.14. Whereas over that same period, the S&P 500, that $1 would have only returned or turned into $6.60. So very impressive growth over that period. So I'm going to go through some quotes here from the introduction. So starting off, he says, I own stocks where results depend on ancient fundamentals. A successful company enters new markets, its earnings rise, and the share price follows. The typical big winner in the Lynch portfolio takes 3 to 10 years or more to play out. He also says, I subscribe to the crusty notion that sooner or later earnings make or break an investment in equities. And I could relate this back to Mogo. That's something that we're seeing. The risk outweighs the reward right now. If they never break into earnings, that could break the investment in Mogo. And he also says, all you need for a lifetime of successful investing is a few big winners. So I'm sure, podcast listeners have heard us say very similar statements to these before. That these are very close to our strategy because, of course, we are growth at a reasonable price value investors. So he also says you don't have to be trendy to succeed as an investor. He says most great investors, such as Warren Buffett, are technophobes. They don't own what they don't understand. And an example of this would be Sona Nanotech, which, we had red flags around in 2020 when they announced that they were developing the next best rapid COVID test for testing for COVID-19. And it was due to their nano gold technology. And, the stock did have a great run on speculation, but absolutely collapsed right back down. And we got comments back on the internet saying, you guys don't understand the technology. Well, you're right. We don't. And that's why we stayed away from it. We're not scientists. We're fundamental value investors, and we're not going to put our money in something based on the hope or something that we don't understand. Now, I like this quote. He says, stock market news has gone from hard to find in the 1970s to the early 1980s, then easy to find in the late 1980s, then hard to get away from. It's very hard to get away from, the talking heads on, any kind of financial news. And people are advised to think long term, but the constant comment on every market gyration puts people on the edge and keeps them focused on the short term. He makes the point where realistically, people shouldn't look at their portfolio, for every other, 6 months, essentially. You don't need to focus on what the stock market is doing day to day. And this is kind of relating to, fundamentals around the tech bubble, essentially. He says, with today's hot internet stocks in the 2000s, when he was writing this, fundamentals are old hat. So essentially, we saw this in 2021. Fundamentals became old hat, is what he would say, with stocks trading upwards of 100 times sales and no earnings. And he also says, thanks to the internet, 500 times earnings has lost its shock value, and so has 50 times earnings. And again, we kind of saw this, just recently. He goes on to say, the .com is enough to convince today's optimists to pay for a decade's worth of growth and prosperity in advance. So as an investor, when the market gets completely overvalued or specific names get overvalued, essentially you're paying, a premium for their growth. And, it takes them, just generally, you don't want to overpay and pay, 50 to 500 times earnings for, some of these businesses, because it's going to take them a long time to grow into that actual valuation. And lastly, wonderful companies become risky investments when people overpay for them. And he uses the example of McDonald's, where in 1972, the stock was bid up to 50 times earnings. With no way to live up to these expectations for growth, the price fell from $75 to $25, which presented a great buying opportunity at a more realistic 13 times earnings. And these essentially are just his books here. And yeah, that sums it up. I just think that, he's a growth at a reasonable price investor. I'm really enjoying the read. A lot of what he says, relates exactly to what Ryan and Aaron have taught and, preach and have preached over all of these years. And if I come across any more quotes, I'll definitely bring them up on the podcast as well. And any of his real life examples. He likes to use real life examples, which is good.
I like the quotes, especially when he's talking about how stock information became easy to access in the 80s and then hard to get away from. And I imagine that's he's talking like in 2000 around, right? So imagine he wasn't even fast forward to now.
It's 10 times what that was.
It's 100 times. I mean, social media, more people on the internet. It's just people are absolutely inundated with information about unlimited things all the time. And the problem with that is that a lot of information creates the illusion that you're well informed, but actually in many ways it can also do the opposite, because you become overwhelmed with the information. You're constantly guessing. But one question I have about Peter Lynch is, so he seems to, his entire investment career, or the career that he's famous for, was between 1977 and 1990. So about 13 years. Has he done anything or said anything in the last 20, 25 or 23
Not
years?
really. From my understanding, he retired at, I believe he was only 46, in 1990, and he retired, and then he just kind of started doing his own investing and kind of philanthropy. So he does give away a lot of his money. And then as well, I believe that he's actually still with Fidelity, where essentially he kind of mentors the young analysts. Now, I don't know if he's still doing that, but
He did like George Seinfeld in the episode of in Seinfeld, or George Costanza, sorry. He got out when he was on top, right? Remember that episode where he's like,
I was going to say,
I'm getting out on a good note, and he got
getting out on a good note, because he continues to be. If you Google the best investors of all time right now, you're going to find Warren Buffett right at the top of the list, and you'll usually find Peter Lynch at number 2. But his career was relatively short. 13 years, and that ended like 32 years ago.
Brennan, I was just going to say the Magellan Fund. It is Magellan. It comes from, do you know where it comes from, the name?
I don't. No, I don't.
Ferdinand Magellan. He was like a Portuguese explorer. He was the first credited with circumnavigate. So that's kind of where the fund got its name from.
Interesting. I didn't know that. I like history.
Investment fund to circumnavigate the globe.
It's funny. Exactly. I think it travels the world for great investment opportunities. He did himself, or just the fund did without him. So, No, I thought you'd know the Magellan because I make that quote about the 10 stocks if you like those, and he managed the Magellan Fund. And I've literally made that.
Brian thinks we listen to his speeches.
I thought at least Brennan would. I thought at least Brennan would be listening to them at one point, or because he had to edit them. Yeah, apparently you pretend well. So that's all we want on that. I mean, I think the quotes, like Aaron said, they're great quotes. Like making 2 or 3 investments that are great investments in your life can change your life. And it's true. Like I literally gave a speech without reading that book about that topic. And it is true. Like then some of the most boring businesses that you can understand, the Boyds of the world, the Expels of the world, juxtaposed against like the latest technology in Sono Nanotech or Cielo Waste, or, revolutionizing the disposal of waste. Like how about just a business that creates a ton of cash flow that everybody needs and keeps growing with great management? Like forget about all the other crap and just invest in those. And it's kind of what he's saying in those, and how impactful if you grab 1 or 2 of those in your entire investing lifetime can have in your portfolio. And this is when we're going through the TSX and the venture right now, and we're going through 3,000 companies in the US. When we go through all those businesses, that's what we're looking for. Maybe it's an exciting business, or maybe it's a boring little business that just keeps presenting and pushing cash flow out and has a competitive advantage and is going to grow that over time. And we just found a really obscure company in the US that is profiling towards that. It doesn't mean it's going to be one of those ultimate successful companies in your portfolio, but if you get that company, get 15 or 20 in your portfolio that have that criteria, 2 or 3 of them, or becomes one of those companies that has tremendous long-term returns that can power your portfolio over the next couple decades. And that's what we're looking to do.
Even in the introduction,
finding that model of companies.
Yeah. Even in the introduction, he makes the case where it's like, you only need 50% of your stocks in your portfolio to do well and have some very strong outperformers in there in that group. And the other 50 could technically go to 0 and you'd still be up essentially. I mean, it depends on what return you're getting, obviously, in those, specific securities, but, he's just making the case that exactly that 2 to 3, great.
Yeah. We literally had the real world example of a client who had taken 15 stocks and like put 50,000 or in each of them. And one of them happened to be Expel. And that $50,000 investment was worth $2 million on its own. And I think the original investment was around $1 million in that range. So even if all 19 other stocks, something like that went to 0, you'd still be 50% or 100% higher in that portfolio, which is shocking. The goal is not to have all 19 stocks
and
go to 0.
Those types of stocks, I mean, they come around rarely, but they do come around, and you don't have to take.
And you're talking about maybe 2 in your life. If you can get 2 in your life, you're going to do well in your portfolio. And it's hard to get 2 in your life. Let's be completely honest with that. It is hard, but going with a profile of the stocks that we're talking about, you have a chance to do that. You don't have a chance if you're just looking for a hope and a prayer. You're going to end up with 0 instead of a profitable business that can grow.
One of the
all right now let's
go on.
Go. What were you saying? I'm just going to move on to the next segment. So.
One of the big winners that he references over the time of in the 1990s is Dell. And it's just, that was an easy trend to follow. They were really getting profitable, and $10,000 invested in Dell in the 1990s, I believe, turned to 8.9 million. Over that decade.
Anyway, that's an okay return. Yeah, it's pretty good.
Yeah, not bad.